64,000 is the November number. The U.S. economy adding 64,000 jobs in November. That is above the 50,000 that was estimated. However, the unemployment rate ticking 2 ticks higher to 4.6%. That is a little bit worse than had been estimated here. Looking at some of the other numbers, we've got average hourly earnings rising considerably less than estimated, 0.1% on a month-over-month basis. The labor force participation rate at 62.5%. So those are the numbers writ large here. October non-farm payrolls falling 105,000. That is a much steeper drop than had been estimated here. So all of these numbers on balance are mixed, I guess is what you would say when all is said and done. And as I was just talking about with Joe a few moments ago, this is indeed a noisy number. So just summarizing here again, 64,000, the addition of jobs in November to non-farm payrolls. At the same time, the unemployment rate going 0.2% higher to 4.6% from where it was on the last read, the last time that we got a jobs report, and average hourly earnings rising only 0.1% on a month-over-month basis, although I guess month-over-month is kind of tricky here, 3.5%, let's call it, on a year-over-year basis, and October payrolls falling by 105,000. I'm still going to be looking for these revisions here that we were just talking about with Joe that we could potentially have because of maybe an overall worsening labor market here. So that's something I'm just going to look here. The change for August revised down by 22,000. That means the total job losses in September, or in August, excuse me, were 26,000. For September, we saw a revision downward of 11,000. So still saw a gain of 108,000 in the month of September. So noisy indeed, but seeming to again show this overall slowdown. We were just looking at futures here and you know, because these numbers are more complicated than usual, it might take a little more time for investors to sort of digest them and react. But the first blush reaction, very slightly positive here on these numbers. Joe, I'm going to go to you first. We were just talking about what we could expect here. As you said, revisions lower for August and September. That big drop in October. What do you make of all of this?
Okay, well, we got to look at the composition, but my sense is that's going to be about the Elon Musk Doge era government layoffs. So we'll want to look at the private payrolls numbers in that month once we get that data up. But what I'm seeing here is the 3-month average is now 22,000. That's well below what I think is the 50,000 break even, and slowing wage growth probably reflects some of the sour holiday spending sales that we're observing. My sense is this will tend to reaffirm those at the Federal Reserve who wanted to make the rate cut here in December. Now, my sense is that we're looking at this other data that's coming in, and you saw retail sales stagnated on declining motor vehicle purchases. So I think the totality of it, at least at first cut, before we can really dig in, it's a bit weak today. Yeah, and so as you mentioned, we got those retail sales numbers as well, and those coming in, as you mentioned, weaker than estimated, month over month in October, flat. Again, this is October numbers, so a little bit backward looking, if you will, excluding autos, up 0.4%. So as you talked about, auto sales contributing somewhat to that. Ed, I'm going to send it over to you here. How do you read this jobs report, and what is this going to mean for the rates market?
Yeah, absolutely. So if I was to boil it down to one number, it's that November unemployment rate, and the 4.6. Not only is it going to reaffirm that making a move in December, that cut in December was appropriate, but it's going to open up January now for us. The odds of a January cut were roughly 1 in 4 going into this, and I think they're going to have to tick up.
Really? You think that number is enough to make more of a case for the Fed to be able to cut again in January?
I think that's right. Unemployment exhibits this really unfortunate dynamic in which it increases slowly and then rapidly. You don't want to get to the rapidly portion. And so from the Fed's perspective, front running that, putting an additional, some additional amount of easing into the system to reduce the odds that, we end up in a bad place with respect to the labor market makes a lot more sense after this labor print than it did even a couple weeks ago.
Peter, what's your take on all of this?
One, I agree that we're probably going to get more rate cuts early next year. I think the one positive thing here is labor force participation ticked up a little bit. So people are trying to come back to the workforce. That did put some pressure on the unemployment. Though having said that, my favorite data point for the last few weeks has been the JOLTS quits rate. To me, that's the closest we get to something that's kind of crowdsourced, right? People know they can quit comfortably and get a new job. That's when they quit. We're not seeing that. It's at the lowest levels it's been since 2014 outside of COVID. So there is something I think wrong in the labor market, and this data continues to highlight that. And I expect a lot of companies are not budgeting to hire a lot next year. So this is going to continue. So I think there's going to be weakness in the labor market going forward, and the Fed's going to be forced to cut sooner than people are currently pricing in.
Joe, you are digging through this report to find the numbers that you need, and you found the number on government cuts.
On the government hiring in October, there was down 157,000. That's a lagged reaction to what happened early in the Trump administration. So you want to exclude that from your assessment of this report, because when I took that out and I looked at total private hiring over the past 3 months, the average is actually 75,000. So as we begin to look at the composition here, I'm going to take the other side of Pete's bet here. And it looks to me like private sector is continuing to hire. My sense also is we get those tax cuts, you get that full expensing, you're going to see hiring stabilize early next year, and we're going to continue to hire, not at big numbers, but enough to keep the labor market stable.
Okay, just to put a pin in that for a minute, just to make clear to folks who are watching right now, when you talk about 157,000
that's right.
government
Decline.
Jobs being eliminated, and you talk about this is a legacy of what happened, this is because when Elon Musk came in with his Doge and offered people buyouts,
They took them.
They took them, but they did not go off the government rolls until
6 months later.
6 months later, so October.
4th month to 10th month, and that's why it happened right in October.
Gotcha.
So you can see that here. Now, there are some weak spots here. Leisure and hospitality hiring, which you would have thought would happen in November, didn't happen. It actually fell. Most of this is really just simply around private education and health services. With a little bit of help in a retail trade there, but it's there, it's occurring, but not what you want to see, right? But it's not negative either once you correct for that one-time effect from the Doge layoffs.
Well, and Ed, if you're talking about a cut in January, I mean, we do get another jobs report before the Fed meets again, and so that could show, that will provide maybe a little clearer picture, because this is a noisy report, and it could potentially show more signs of stabilization that wouldn't give the Fed material for a cut.
Yeah, I mean, unfortunately, the data has been murky all year. We've had massive, massive changes in terms of the composition of the labor force, immigration, obviously changes on the government side. But from the Fed's perspective, it's a risk calculus. You're never going to have certainty. Do you want to take the risk that you're in an environment where the labor market is cooling to the point that the unemployment rate's going up? At this point, it has exceeded the Fed's forecast for the end of this year. And the Fed's forecast for next year are at risk if the unemployment rate continues to increase. Do you want to take that risk? Do you want to kind of take it month by month? Or do you want to take some more preemptive action to put some easing into the economy? With this Fed, I'm going to bet on the latter.
Ed, what about the inflation risk? And is the persistence of sort of higher-ish rates on the 10-year indeed a reflection that the market thinks inflation is sticking around?
Yeah, it's difficult to be sure, but if we look at market measures of inflation, they haven't moved meaningfully higher. That inflation compensation in the bond market has remained relatively low and is in fact at multi-year lows, in part reflecting downward pressure on oil prices. I don't think markets are particularly worried about upside inflation risk. And the Fed is quite explicit in telling us that upside inflation risk is quite manageable relative to what's going on in the labor market at the moment. So put a lot more weight on the labor market in the Fed's thinking process and strategy going into next year.
Peter, I'm looking at futures here. They went up a little bit. Now they're going down a little bit. It seems like as anticipated, maybe there's a little bit of difficulty here in trying to parse this.
Yeah, I think we had an initial reaction where everything looked, Goldilocks, I guess, for lack of a better word. I think the reality is setting in that this number is very hard to decipher. It doesn't tell a huge story. And let's get back to the real issues. What's happening with the AI, the data centers? Is that spend continuing? Is it going to continue to grow? Is that going to be a driving force for stocks and the market? And I think that's the big question mark. And I think you're going to see some selling pressure as people question whether we're able to grow that. And again, I think we're going to have this massive focus on electricity. Electricity is a bottleneck. What we're going to do about that? Can we grow that out? So I feel there's just pressure coming in the markets, and this number, now that we got through the noise, we can focus on that, which is probably one of the big stories coming into next year.
Well, Pete, one of the things that's interesting here is despite a very weak wage growth number, which is almost certainly due to the government data, higher paying jobs in goods producing and construction picked up 19,000 in goods producing, 28,000 in construction.
Well, is construction all data centers?
Well, I'm thinking that's got something to do with it, right? And I mean, there's a financial markets discussion, but then there's a real economy discussion. I was down in New Orleans over Thanksgiving, and we had a chance to talk with some people who work for Entergy. And they got 8 big construction projects just to support the Meta call center. That's going on all over the country, right? It is meaningful at a certain point in the real economy when those construction jobs are helping offset the weakness in the housing sector, right? And so I'm very optimistic around that area, even if perhaps valuations are a little overstated right now.
Right, that's as you said, the economic versus the financial market.
That's right,
discussion.
yeah.
Jennifer, let's start with you. On the one hand, this is the 4th straight month that we've seen the unemployment rate tick up. We haven't seen that in years, but these numbers are pretty hard to parse.
Yeah, I just want to say that ordinarily a jump to 4.6% on the unemployment rate would have really caught my attention and the Federal Reserve's attention. But there's a lot of anomalies in this report. For starters, we saw so many government workers roll off the payrolls. For the month of October, 162,000 government jobs rolled off because remember, they took those early resignations. On top of that, 6,000 jobs off in the government sector for November. So 167,000 total for October and November. That alone, I wonder how much of that is pushing up the unemployment rate at a time when labor force participation rate actually inched up as well. And the Labor Department says, look, the standard statistical errors here are much higher because of survey response, because they skipped October. They said they're going from a comparison period of 12 months versus month to month because they had to skip the October period because of the government shutdown. And so I think that, we heard from Chair Powell, and he said, look, we're going to take a skeptical eye to this data because the shutdown is going to not give us a full, clear picture of the data. And that's exactly what we're seeing this morning. So I don't think this changes the Fed's position at this point. Maybe it gives them some sigh of relief that they did cut last week, but I think we're going to need to see another labor report that's not clouded to the extent that this is before we get a better reading on the job market and for the Fed to move forward at that point.
And Jen, we're going to be getting CPI this week as well. But I mean, again, when you look at these numbers, what do we need to know looking ahead to January and how all of this is going to start to maybe smooth out or become a little more clear?
Yeah, so we need to see if this weakening trend continues in unemployment, because if it does, then that's going to bring inflation down. If this is an anomaly and we do see, it swing back up, then, maybe that has other implications for inflation. The fact that the labor force participation rate inched up 0.1% indicates to me that there's not as much weakness, perhaps, in the labor market than these numbers would put on, which would mean that you would have a bit of inflationary pressure at that point. And we heard from New York Fed President John Williams yesterday, and he's forecasting a very strong economy for next year. So we have to see how demand responds, though he sees inflation starting to come down to 2.5% next year, as he thinks those effects from the tariffs have already been factored in the first half of the year. So we're really going to have to see how things actually play out here and whether companies end up passing on costs to consumers, whether consumer spending remains strong, and really what happens with the job market.
Has this done anything for you in terms of reinforcing a view that I think the marketplace has that we need more rate cuts from this Fed, and in January, that's what they have to come on here and deliver?
Well, we definitely don't need rate cuts. The credit spreads are at historic lows that you haven't seen only a couple of times in 35 years. So it's really not essential to cut rates. With that said, we believe the Federal Reserve, though, will do the opposite. They will be extremely dovish going into 2026. I think I give it a 50-50 toss-up between a 0.25% rate cut, but I do believe that they will start to message in a much more dovish tone as you see a new candidate come and emerge out of the White House.
Are you not concerned about jobs not being created at a rapid clip, though?
I am concerned that there's a deceleration of economic activity, but overall, we believe that there will be somewhat of a fiscal thrust in 2026. And if you get some transparency on trade issues, that too will be a tailwind for the economy. I am also concerned, though, that inflation is stubbornly above 3%. That could be a bit of an issue if you see a more dovish Fed chairwoman or chairman come in. That response on the long end of the curve may be very, very concerning.
Brooke, anything to get excited about in these retail sales numbers that also hit?
I mean, retail sales, when you take out the spending on auto parts, on car spending, they did see a pop of about 0.4%. That was more than what economists had expected of a 0.2%. But with the purchase of cars, which saw a decline of about 1.6% during the month of October, then retail sales came in flat, and economists had expected a 0.1% pop. And where we're seeing consumers go, or retailers that you would largely expect, it's food and grocery stores, it's general merchandise stores, it's even furniture stores. And what they're not spending on are things like building construction and also perhaps, more expensive vehicles, it seems, as well.
And as if the economy doesn't need another rate cut, why are Costco pizzas flying off the shelves? You sent me some great research early in the week. I mean, it made me chuckle at first. But you've been on the pulse of this story literally the whole year.
Yeah, that's right. And that research came from Fundstrat, basically saying that in October for Halloween, they had their record sales of their pizzas at the food court. And those pizzas sell for about $9.95. So look, that is an inexpensive pizza pie when you compare it to other places. And this really talks about the K-shaped economy and the fact that people are gravitating towards less expensive products, towards less expensive food, because they have to. And if you take a look at the jobs report, I found two very interesting points. One is multiple job holders was up by 750,000 year over year. That's people that are having more than one job. And also people who, the number of people employed part-time for economic reasons, that increased by more than 900,000 from September. So these are individuals that would want a full-time job, but they can't. They have to have these part-time jobs because perhaps their hours were cut back. So this talks about that K-shaped economy, people that are gravitating more towards less expensive products, those pizzas from Costco. And look, I was just there the other day and I was looking at those food court prices. I said, it's hard to beat. You can get a soft drink for still 80 cents here when you compare it to a fast food place, $3.50 for a soft drink.
I know this is serious reporting, Inez. I'm just cracking up here. But no, Inez, hold on. We're going to hear a different message, I'm sure, from the White House at some point today. The economy's rocking. Things are good. We're going to see a manufacturing boom. Well, if that's the case, shouldn't Costco pizza sales be going down?
No, I mean, look. They offer a value, and they they are keeping those prices the way they have for years now. And people are, look, you've got the people who are going from the 100,000 household incomes that are going to Walmart, that are shopping at the lower price point places. We've heard this over and over again. Affordability is a problem. This is something that the Trump administration is very much aware of, and we're seeing it in some of this data.